Hello fellow human, nobody here with a new stock analysis. Today's question is, should you buy Celsius shares? As always, I will jump straight into my verdict and I will give you my reasons afterward. Let's go! At today's price of $48, Celsius stock is a buy. My price target for January 2026 is between $70 and $110 for an average of $90 per share. This means I believe the shares have significant upside potential for the next year and a half, and so they make a very attractive investment option right now. Celsius, both the company and the stock, have exploded in popularity in the past few years. This has resulted in exponential increases for both sales and the share price. But then in May, just as quickly as it had approached the $100 mark, the stock began to crash. Since then, the share price has lost 50% in just 2 months, leaving behind a funny two-hump chart. You might be suspicious of this kind of wild movement, and you should be. This level of volatility is often seen in bullshit investments. In my verdict, I already told you I'm optimistic about the stock. But why? Let's talk about it. But first, a little disclaimer. If you're watching this, I assume you're not a lemming, but a sovereign individual. Nobody can tell you what to do with your own money. I only provide you the tools to take financial matters into your own hands. You alone are responsible for where you place your time and money and trust. So no, this is not financial advice. This is just how nobody invests. Celsius is a growing player in the functional energy drink market. It targets health-conscious consumers with products designed to boost metabolism and support active lifestyles. The company offers several lines of products, such as Celsius Originals, which is the flagship line of ready-to-drink metabolism-boosting beverages available in multiple flavors, Celsius Heat, which has higher caffeine content for intense workouts, Celsius BCAA Plus Energy, which is designed to boost physical performance and recovery, and Celsius On The Go, which offers the benefits of Celsius energy drinks in a convenient powdered format. The main competitors in the energy drink market are Red Bull and Monster. These two companies have strong positions, but Celsius markets itself differently. Yes, they are all energy drinks with high caffeine content, but Celsius targets consumers with a more health and fitness-oriented lifestyle. One surprising thing about Celsius is that, despite its recent popularity, the company was founded 20 years ago. Which begs the question, if most people had never heard of the name until recently, is this an anomaly? Is Celsius just a short-lived trend? To see if it's legit, let's first take a look at the company's past performance. In the past 10 years, the company's revenue grew at an average of 62% per year. In case the number didn't sound impressive enough, you can appreciate on the chart how insane growth has been. As is usually the case for hyper-growth companies, earnings were pretty much non-existent, as everything the company earned was reinvested to maximize growth. That said, in 2023, earnings finally made a significant jump. So, while favorable changing health trends have helped, Celsius didn't come out of nowhere, and its growth doesn't look like a temporary trend. Also, it didn't succeed just due to lucky trends, but because of improved marketing campaigns, product innovation, and expanded distribution. And by expanded distribution, I mean Pepsi. The two companies entered a partnership that allows Celsius to sell its products through Pepsi's massive distribution network. To give you an idea of how huge this is, Pepsi already makes up for 60% of Celsius' sales. Is this as good as it sounds? Will Celsius conquer the world through Pepsi? Let's take a look at future growth estimates. For the coming 3 years, analysts expect an average annual growth of 26.3% for revenue and 33% for earnings. Although it's good to be able to include earnings into the picture now that they are positive and growing nicely, the revenue deceleration is quite significant. After having doubled sales in 2021, 2022, and then again in 2023, revenue growth of 26% sounds pathetic. After all, Celsius still has 5.5 times less sales than Monster. So, is 26% too little for Celsius right now? Should we worry about the slowdown? Let's compare it with Monster's past growth. In 2015, Monster's revenue was the same that is expected of Celsius for 2026. And how fast was Monster's revenue growing? 12%. Celsius is expected to grow more than twice as fast. Two things keep me very optimistic about the long-term growth. First, Monster has continued to grow at the same pace of 12% since 2015. So, for this kind of company, growth can be sustained for many years and doesn't just suddenly stop. And the second thing is, 96% of Celsius's sales are still in North America. The company literally has a whole world to grow into. In fact, because of how much room the company has to grow, the current growth estimates seem conservative to me. But better this than the opposite. So let's work with these estimates as they are. The only question left to answer is, does this growth potential justify the current valuation? Let's take a look. Here I'm using the 7-year average for the revenue multiple and the 5-year average for the earnings multiple. As you can see, valuation multiples today are lower than their past averages. Lower multiples are reasonable to the extent that growth slows down. In this case, the multiples look cheap given the expected future growth. For example, the expected 33% earnings growth results in a modest PEG ratio of just 1.4. Also, over the past 10 years, Monster's revenue multiple was 7.7 on average. Today, Celsius's revenue multiple is 6.4, lower despite much faster growth. Additionally, Celsius already has a gross margin of 50% and a net income margin of 19. Very similar to those of Monster, despite Monster being a significantly more mature company. All of this sounds great. But why did the stock crash then? Really simple. Pepsi built up its inventory too much in 2023. And this year, it's buying less from Celsius because it needs some time to pass this inventory on to consumers. Essentially, 2023 stole sales from 2024. As a result, sales this year look comparatively poor, and people panicked before taking a good look. But no, consumer demand for the products hasn't suffered, which is what matters. To sum up, Celsius's excellent growth is far from over, and shares are cheap thanks to the recent crash. I consider this an excellent investment opportunity that has the added bonus of being a business that is easy to understand. I expect the stock to return at the very least 16% per year in the next 2 years. And beyond 2026, a return of 20% seems easily achievable as Celsius takes over the world. If you found this video only my live setting, please like it and subscribe to the channel for more. Share your thoughts in the comment section and let me know which stocks and concepts you would like me to explore in the future. If you have any questions, just ask. And until the next one, remember, if nobody invests, so should you.